What is the projected benefit obligation? It's your total liability. Every year, your liability increases for the benefits earned in the current year. So service costs or the benefits earned in the current year, they will always increase your total pension liability, will always increase your projected benefit obligation. And every year, your projected benefit obligation will always increase for interest. And you need to know how to calculate the interest cost. Now, if benefits are paid, that would decrease your pension liability, your PBO. And if there was a PBO gain or loss, that would affect your PBO. But in this example, they say that there were no pension-related other comprehensive income accounts that required amortization. What they're talking about here would be the possibility of prior service cost or of a PBO gain or PBO loss, but we can ignore that. So let's look at the answer here. How did they get the ending PBO? Well, the beginning PBO was given at 80 million. The service cost was given at 10 million, but the interest cost was not given. How do we get that 4 million? Well, the answer is we take the 80 million. That's the beginning PBO was 80. You take and you multiply it by the discount rate. That discount rate of 5% was given. 5% of 80 is the 4 million. So that increases your PBO. There was no gain or loss on the PBO, or there was no prior service cost. And notice that the retiree benefits decreases your liability. If you pay someone back the money that you owe them, you no longer owe them, so that would decrease your liability. So the answer was 88. So we need to know how to get to the ending PBO. So this was a very good practice problem for that. So let's continue on to our next problem. This is brief exercise 17.5. How do we get the plan assets? Now, if you remember, the plan assets, we start off with the beginning balance, and then we would add the actual return on plan assets